So as we kind of put this panel together, the idea was to think about various pathways to finance a company. You guys can choose whatever. And these three gentlemen have been very successful, and they've taken slightly different paths to where they are today. I will do some quick introductions. Dave Dinesen is the CEO of Cubic Farms. I'm going to ask them to, each of them, to tell you the most important things about their company, but Cubic Farms is part of one of the big trends that we've seen, which is the controlled environment growing. Lots of really big companies like Plenty, the Bowery, Gotham Greens have raised hundreds of millions of dollars to grow stuff indoors. Cubic Farms has a very, very interesting approach, and I'll let him tell you how they moved to fund the company. Hamlet is a slightly earlier stage than his compatriots, but again are really riding the wave. Novobind is providing a solution to antibiotics to treat various pathogens, primarily in animals, but we're looking at lots of hosts. So lots of things to be doing. And Michael Gilbert, the CEO of Semios. Semios is a precision farming Internet of Things platform that has had a great year. Let's put it that way. So what I'd like to do, and do we have the second mic that's working? I'll give this to Dave. So the first question I have for the panel is a hard one. I'd like each of you guys to just sort of share three things that the room should know about Cubic, Novobind, and Semios. You only get three.
We're an automated vertical farming, controlled environment agriculture tech company. So we grow lots of produce at commercial scale indoors. We use a machine to eliminate most of the labor, reduce energy, and grow lots in a very small space. We were founded by Dutch greenhouse farmers, and they know how to make a lot of things with very small amounts of money. So that would be, I think, the history of our business.
Okay. Hamlet.
Thank you. So we punch way above our belt. We're really good to work with, and we're looking to expand into multi-billion-dollar sectors. So if anyone's interested in working with us, that's our growth plan.
And Michael.
All right, three things. I wrote a few things down here. First thing for us was our business model. So we went into the market with a subscription model, so on a fee per acre per year. We charge anywhere from $100 to $300 per acre per year for our services. It's capital intensive, so you have to have the right investors on board, but it really lines up with the cash flow of the business of the customers. So that worked out really well for us. One thing we did early on is we went right to the biggest, best customers in the world. So right down to California and Washington. There's lots of folks here in BC we could have gone after, but the big customers tell you everything you need to know about your business. And that helped us learn a lot and build a product really quickly in the long term. And last one was we focused early on profitability. So no free trials, and we went right away to make people pay for their product. People care more when they pay, so you learn more about the product. And that allowed us to get to profitability much faster, I believe.
No free trials. And I would say one more thing about Semios. The comment I made during the trend presentation around being able to draw a direct line between your product and an economic outcome for the customer, that is why Semios has succeeded in the precision farming area, because I think you guys are, how many acres now?
120,000 acres.
120,000 acres, growing significantly next spring, because they were able to demonstrate a very specific value economic proposition to the customer. So I want to shift gears and talk about the financing journey, because we're all here because we're interested in investing. If you invest, good things can happen. Here are three examples of good things happening, but they happen in very different ways. So Dave, I guess I'd ask you to take a little bit of time and just give us a sense as to what that journey's been like. And obviously, you're a public company now, which is quite different than many. But would love to hear a little bit about that journey.
So we started the business about 4 years ago. The tech had been developed by a large greenhouse concern out in Langley, BC, Bevo Farms, the largest propagation greenhouse operation in North America. And they had developed this automated vertical farming indoor machine to grow lots of produce with a small amount of energy and labor. And when they were ready to take that to market, that's when I got involved. And so we did about 5 rounds of fundraising. The first initial seed round, that's the round that everybody loves to get in. It's the highest risk, but with the highest reward. So we did that one, and then we focused on getting sales as quickly as possible. Once you can get some sales, that really gives potential investors a lot of relief. What is the path to cash for this business? So we focused early on getting initial sales. Let's get our first deposit for our first system. And we did. And that let us to take our initial valuation. We did a seed round at about a $250,000 valuation. The next round was a $10 million valuation. We did 2 at that. Then we did a $50 million round. Then we did a $100 million round just about a year ago. The $100 million round, all of those rounds were with angel, friends, family, investing networks, things like that. The $100 million round, that's when we got our first institutional investor and a strategic partner. Getting that strategic partner to us has really put gasoline on our fire. It's been a great experience. With respect to going public, most days it's the worst thing you could possibly ever do.
Here.
Unless you're someone that likes to have sleepless nights and check your stock price every 10 minutes. We went public because we were owned partly by a publicly held company, and they were about to be acquired, so they spun us out. So we now had 1,000 shareholders, and we were able to do a direct listing. So we were able to list without having any dilution whatsoever, and shortly we'll be doing really a proper IPO, which we'll be doing this winter, and doing an uplist to the TSX. So it's been an interesting journey. I would encourage you actually not to go public too soon. The best thing, though, about being public is if you do go public, you can now use your stock to make acquisitions. So without really giving anything away, that's something that's sort of exciting to me.
Thank you. And same question for Hamlet. You haven't done the $100 million round yet, but
Not yet.
We're looking there.
So great journey. So we took a different approach. I was at a point in my life where I wanted to tackle big ideas. I wanted to self-fund them, and I had the crazy idea that you could make change on $250,000 of your own money. So we the strategies we took always had an element of constraints and overlaid with strategy of how we can build in future optionality, what each decision at every time point meant to the future, and sort of work backwards. So from the get-go, we built in a really amazing team of people that could come together and look at cracking that kind of a nut. It was important for us to be super lean, so we had to identify platforms and technologies that we could impact with small amount of capital. At the same time, we needed to be the best in the field to have future growth. So, we took a approach that, cost me my hair and my great figure, but we turned. I like to say this: we turned away about 5 times more money than we ever took. We chased a lot of rabbit holes. Some of our advisors gave us a lot of heck for that. But every step of the way, we stood back and said, "What are the values? What are we enabling? What optionality are we losing?" And we're very sort of realistic about the challenges that we'd have to face, the negotiating powers we'd have to overcome, the terms of each deal at each stage that we'd have to accept or deny. And so that led us, in a way, down some narrow halls, right? So if you know your value base, you've got a team of people around you who are saying, look, we don't want this type of investor or that kind of investor. And you go to the market and you realize every investor has their own constraints and their own frameworks that they need satisfied. You realize you got to get out there and meet a lot of people. and then find people who are willing to join the journey, understand that there's upside, understand the risk, and then come together on a trust level so that you're never looking, over your shoulder internally. And so where we've been very successful is we've taken that approach and used that to find investors to, understand thoroughly the technology, understand the business model, understand how we can disrupt the multi-billion-dollar industries. And for those who don't know, we are essentially in our freezers in sort of East Van, we have solutions that can address $20 to $30 billion annual losses in chicken and shrimp. This is with everything that's out there. So all the antibiotics that are out there, all the technologies that are out there, they're still using $20 to $30 billion worth of crop. So strategically, you pick good areas to be in. Then we look back and said, okay, for us to be able to get there in 1, 2, 3 rounds of investment, who do we have to bring along, right? We can't afford a giant management team. So how do we bring an investor in that reaches technical strategy, matter expertise that can enable where we want to go? Now, to that end, you want a local, a national, an international VC. You want anchor with a strategic. And so, we were the babies of the world walking around talking to giants. And I'm talking about multi-billion-dollar companies at C-levels and trying to make our way and say, hey, don't just squash us. We're here. We have an idea. We have some patents. Is there a way for us to work together, work within your constraints, and can you take an early gamble on us? And so we ended up doing multiple things. We got term sheets from larger VCs for lots of money. We huddled and we realized that didn't align well with where we were going and the optionalities we would lose in the next couple of rounds. So we reinvented ourselves. We said, look, let's find an enable strategic that could give us internal distribution globally and scale up capabilities, who is friends with everybody in the market that we want to deal with, all of our customers. And so let's use that and say, couple that with a VC term or VC group on our terms that they could price the deal. So now you have somebody who can actually diligence the transaction and the opportunity. Then you price it with somebody who can have a proper conversation around terms. And let's do small bite-sized chunks, but bring a community together that essentially would triple or quadruple our reach and our management capabilities in a specific vertical. So our business model for our core IP portfolio is more licensing. So we don't want to actually get out there and sell stuff. We want to create the technology and we want to hand it over to people who can do that. Now, as we grow, and this is the next stage, we're looking at, a few different ways of doing this. One, we've brought a group of people in on our sort of Series A that could fund a 50, 60, $100 million round. We've also got the same group of people who could become the anchors into new areas. Simultaneously, we're looking at opportunities to partner into new verticals and see, can we generate a revenue-based model for new partnerships where we're sharing risks, but we have set outcomes. And so, multiplicity in that sector.
Great. And Michael, I'm going to ask the same question, but I think interestingly, you've raised a significant amount of capital. You've done it without traditional VCs, and you've done it without strategics. But we've had lots of conversations with traditional VCs and strategics. And so I'd be interested in, as part of that journey, how did you sort of look at those paths and decide, no, I'm gonna take the path I took?
Because it was the right path?
So far.
Yeah, so I founded the company in 2011, and the first 3 to 4 years were pretty much research years. So we funded the company through a combination of angel investors, grants, and then a lot of the EBC credits talked about earlier. And I essentially raise money every year. So, louder. Sorry.
There you go.
So I was out essentially raising cash, for 3 months of every year. And I raised it, so essentially 6 years in a row we raised cash. Every time, obviously trying to get the valuation up. but not too worried about it. I mean, focusing in on what are some key de-risking events and what are some inflection points, and trying to get there and then raise the next pot of cash. And I think the key there was to make those points smaller so you can get them, because the worst thing you want to do is not get to a point and then try and ask for more money to try and get there, because that's pretty tough. So we raised about $28 million from angel investors, about $20 million from grants in those first research years. And then we kind of switched gears. Then we're looking to finance the growth of the company essentially through our customers and through our suppliers. And that was an important part of our growth. We essentially, at that stage, we're obviously not giving away free trials, so getting cash in the company from our customers to pay for our growth. And then, I'm not sure if you guys know about Export Development Canada, but they have an amazing program where, in our business and agriculture, we often have to build and sell once a year, and that takes a huge toll on your cash flow. So we would essentially get EDC to back our orders from our suppliers, allowing us to leverage the government Canada's pocketbook versus ours to do bigger builds and go more aggressive in our growth. So that was really important. And then we focused a lot on profitability. So we were trying to see how fast can we grow and still become profitable. And so trying to max out those two. Often people pick one or the other one, and we were trying to see how much we can do on both sides. And what ended up happening is we ended up getting to profitability earlier than we expected, and that allowed us to raise $100 million, which we closed about 2 months ago. So that allows us now to go even faster. So
I just want to repeat that, okay? They just closed $100 million. I think. Thank you. Yeah. Come on. That is, as I pointed out on the slides, that's going to put, I'll send them and tell them, but it's going to put Semios in the top or the second area on those graphs. And that's a homegrown company that was supported by the Canadian government, that was supported by people in this room, and that's a big deal. Now, why didn't you take the VC money?
That was, why did I take the VC money? I think, so we were approached by both corporate strategics and VCs, and it was, for us, the terms that they were going to ask for, I think especially in the corporate ones, would have tied up our exit, and that would have limited our potential. And we saw so much opportunity that we didn't want to be limited in terms of our growth. And I think once you get into a group of angel investors, and there are many angel investors in Vancouver that will support you if you keep on hitting on your deliverables, right? And we keep on doing that, and that helped a lot. And it was just more aligned with what we're trying to do.
Just to Hamlet for a second, you sort of went around but you did sign, and it was, I guess it's public. We can talk about Lallemont, like it is now. I've said it, but in terms of the benefit that signing a strategic deal had with your ability to raise other capital, can you talk for a minute about what that can catalyze?
Sure, and I'm going to give a shout out to our local NPC Ventures here, VC. There you go. So we picked a great VC, and if people have the opportunity to work with them, that's fantastic. So it was really important for us to fix systemic issues with our business model, right? We had to figure out a way to tell the majors that we're not just a R&D company 2 floors above Semios. So we needed to find a way to have an internal threat. That was number one thing we had to solve. 2, we needed the expertise on global scale up. Those 2 things are really, really big. And without those, even a good technology, people wait you out. So we needed to solve that. And those 2 key issues, I think, were what a lot of the VCs were looking at as major risk steps. And so in consequence, and in trying to mitigate those major risk steps, we would get the terms that you don't want to do, because then you lose optionality in the future. So we found a terrific group. I can't say enough about them. Trust-based, value-based folks. Never bait and switch folks. And what they were able to do is put together a fair transaction with us, a creative one that we worked on, many iterations on. But what we were able to do is say, okay, now we have addressed the 2 key risks that VC groups or angel VC type groups were concerned about. And so that made it absolutely clear on the business model front. More importantly, they were able to vet the technology. And so we could have a data point that said, yeah, this is a great technology, other people have been using it, it works in cancer, why not in chickens?
So as a, to some degree, strategic partnerships and customers by even more powerfully, it's due diligence by proxy, right? A lot of angel investors, we're not deep in the science. We can't figure out exactly what's happening. And so we look for signals, we look for signs, and companies that can have a strategic relationship that says, if this company values it, then there's something really there. And it seems like we're passing the buck, but that's really what happens because we don't have all of the expertise. So I'm going to ask Dave, in the early days, at that, the first round and the second round, what do you think was the reason that people were willing to invest at that stage without the first sales, without the proven tech?
I think there was two things. One, we're in the AgTech space, and our founders were really good growers. Everyone else in the indoor ag space seems to be more coming at it from a business plan. Let's raise a bunch of capital and solve growing problems with the sheer brute force of money, whereas our founders came at it from, we're really good growers, we're going to come at it from the grower's standpoint. So we think that was differentiating. So we had very strong growing roots. The second thing is that those same people realized that they needed to put together a team that knew how to run, scale a business, also raise capital, and that's when I was brought in. So when the tech was ready to go to market, that's when I came in. I had already built another business, had a successful exit, retired for 10 glorious months, and then was brought in to run that. So it was the combination of we know how to grow stuff, and we've got a competent management team that knows how to scale up, raise capital, execute, build a team, all that sort of stuff. Those two things.
So I've got lots more questions. Unfortunately, we are moving through the day, and we've got some other things to do. We're moving to, I guess, a break at this point. But as I listen to these stories, there are a couple of things that come out. One is this idea of validation, okay? External validation. And for all the investors in the room and all the companies in the room, that validation can come in the terms of strategic partners. It can come in the terms of, internal competence. I'm excited about Cubic Farms because I know that Bevo is the best grower in the valley, and the biggest and best one is obviously getting to customers, right? Both Michael and Dave said that we got to get to customers early, and show that we've actually demonstrated value. So if you are looking for investments, I think those are fantastic things to be evaluating your opportunities on. And if your companies, if you can get to those, and oh, by the way, Michael also said succeed and hit all your milestones. Okay, if you do that, it's all good. But really trying to set that up, that'll set you up well for angel investment and beyond. So just join me in saying thank you to the panel, and I really appreciate it.